Good afternoon, almost afternoon, everybody. My name's Dan Hussey with Zaner Ag Hedge, bringing you a strategy of the day update for March 19th, 2020. Today, I promise we take a look at some options and where things might be pricing out. We will take a look at that in a little bit, but first, let's take a dive and take a look at some charts. And as always, everything I mentioned to you today is just my own opinion and not a direct trade recommendation. Trading futures involves risk and can and excuse me, and is not suitable for all investors. Leverage can work for you as well as against you. With all that being said, corn here this morning in the July contract trading at 323. We made a new high for March, actually right into the biscuit close, up into a 325 and a half high after the open. We're starting to pull back now, and we're showing a little bit of back and fill price action, which really, when you dial down to the smaller time frame here today, take a look at what we're trading today. We're only pulling into 50% retracement of the whole rally for the day. If we take a look from the swing lows of yesterday to the high of today, yesterday's high is the 50% retracement. So when you get down to it, this is a series of higher highs and higher lows now for 1, 2, 3 days running. So long as we close above 320, we are closing with a little bit of a bullish undertone. Almost pulled my headset off here. But we are starting to see, 2 steps forward, 1 step back in a market that is arguably trying to make a little headway higher. So now that we've taken out the highs of May, we've made a new high. I do think that we're channeling higher, and we could see upside towards 330 at this time, which is the prior highs and first and foremost, the prior lows from April that then broke. Then were retested as resistance not once but twice here. First mid-April, then into the end of April to hold for the high, going into March or May, which then May really has been defined by a range between 330 and 310. We're in the middle of that range right now at 320. But we are starting to, try to test towards the high end of that range, and maybe building some kind of base is a good sign. We're holding trendline support, breaking trendline resistances, and honestly, the market is in what I refer to as a period of price discovery higher. So we're starting to see that. We've looked at the seasonals over the last couple of weeks, and we know that there's a seasonal trend for corn to get a 20 to 40 cent rally, or even maybe more in some stronger cases this time of year. And we're going to hopefully, continue to look for that seasonal to play out. Now, if we fail to break above 320 and the market to head towards 340, I do think that there's support here that could break. We could see the market continue lower and really have a solid test of $3. But that to me is more of a test of a market that is trying to price, what corn is valued at without ethanol. And I don't think ethanol is totally off of the docket yet. Particularly not because crude oil prices have rallied back, here testing highs of the day, 32.91. That's basically the highs of May and the high of yesterday. So we're flagging inside of yesterday's price action. And really, when you get down to it, we're above 50% of yesterday's rally. So if we just take yesterday's low to high, we're basically flagging today above halfway back, or above, the 3110 area, which that's bullish. This market is making 2 steps forward, taking 1 step back, flagging. Now, if it pushes through highs, that's continuing the trend higher. And I mean, hey, we're $25 off of the low for June in July crude right now. And I'm expecting the market to get back towards the $40 area. And if we get back above there, now we're back to the levels that we were at, from between December and March in crude oil. And if we were to just overlay a comparison here, and make this comparison, I think the default's to the S&P. Yeah, let's make it corn real quick. It's obviously not perfect, but as you can see there, corn on the left axis, crude on the right. Corn around 380 to 390 represents crude at $65 a barrel. Corn at $3 a barrel represents crude at $6.50. So there's a pretty good correlation there of corn trading like an energy product since the start of this year. And that's something we've been tracking. Now, it is worth noting that over the last maybe, up and down here, or up last month or so, we've seen a little bit of a drop in correlation with corn to the crude. And in other words, corn pricing maybe should be a little higher. Arguably maybe more towards the 350 to 340 area if it's supposed to be climbing back up to where crude oil prices were, right? Where were crude oil prices back in March through April, where we were at a $35 to $25 handle, and corn was arguably trading, between 350 and 338. So, and that's in the July contract. So, I do believe that we should, see some price rationing back to that area now that crude has recovered and we're kind of out of the woodwork there for the energy products. But then again, corn is still trying to find its way a bit here. And again, we need to see it settle, I think, above these highs, continue to impress higher, but man, everything looks pretty good. Other than, of course, the USDA is saying we have 97 million acres. That of course, is not the best thing in the world. But we'll deal with that when the time comes. We'll take a look at some ideas and options later, but first let's get through the charts and kind of look at what the rest of the markets have done. Today, soybeans have traded down to retest yesterday's low of 338.5. The low today of 839, excuse me, not 338, I mean 839. 839 and a quarter low today for soybeans. Highs of the day at 48.5. We're making higher highs and higher lows, albeit not as glorious as the way that corn looks in a very nice marching man pattern higher. It is still higher highs and higher lows. And we did defend yesterday's low. We didn't test it. We're trading off of it. If we can settle back, if we settle back above 843 here in July, soybeans, I think that is good enough. For me, we'll probably see retest at 850. And I think the next time up, it doesn't stop, and we get that burst higher. If we fail and we go below the lows here at 840, we settle and we start to go below that area. I do think we're going to see maybe one more drop towards $8, and that's going to be, there's some weight on the shoulders of this market. You can't argue from the 898 highs of mid-May or March, to the lows of April at 818. 50% retracement at 8.6. You traded in a very corrective structure. If this market rolls over, I've got downside targets towards $8, and that could take this market, maybe, hit some stops and maybe even run it a little lower. But for right now, we are making higher highs and higher lows. The 5-minute chart, 15-minute charts, they don't look great. This looks like a market that's rolling over. There is a trend line that's holding here. You're scraping for a reason to be a buyer, honestly, but we haven't technically broken a few key things like yesterday's low. We went through yesterday's high. We we are making, the small key technical, keeping those small key technical importances at work here, and or defending a few key levels. And that's about the only thing we can go on right now. So we'll continue to watch that. There's nothing to really do. There's maybe more continued sideways price action. And that's something to consider about this market, that volatility is down. But if volatility is about to uptick, what does that mean? Are there some opportunities, to look at $8.20 and $8 put still in the soybeans? We'll look at those in a bit to see if there's any opportunity or if there's something we should be doing there. But the reality is that I think, owning calls above 860, owning puts below 820, we're right in the middle of that range right now at 840. But I do think that, there's something to be said for that once the market goes 20 cents in either direction and breaks above or below that higher low of this range we've been in between 860 and 820, I think that's going to be a signal for where maybe the next 40, 60, 80 cents are in this market. Okay, and then now let's take a look here at wheat. The July wheat kind of settling below $5 here today and resting there quietly. Not liking the way this looks. This looks like a market that's trying to break trendline resistance, or excuse me, support, and hold it now as a retest of resistance as it starts to go through it lower. So I am worried that, but while below $5, again, July wheat, we might be gearing up for one more leg lower, and for a shot down towards, if you were to measure where potential downside targets would be towards the 475 to 470 area. And we'll see if that comes to fruition here, and if the market continues a little lower in the near term. I was optimistic that we were starting to see a little bit of a base forming here. Yesterday, I really thought we needed to see us get back above the highs of the day. And honestly, we need to see ourselves get back above the 508 area to reclaim kind of this whole consolidative structure. Today, we do have inside price action. So tomorrow, if we do start to go lower, I do think it is really a tell that we will probably start to fall below $5. If we are continuing to hold and we can reestablish and start a very definitive short covering rally, at that point, I think that we could see, more of a chance of this market reestablishing itself. But we'd have to then get back to 530, and there's going to be a climb here, and there's already trendline resistance we'd have to get back through, or the market would have to get back through. But when you do step back on that larger time frame, you see how this has been a very range bound market between the 470 to 490 area support and the 580 to 590 areas resistance, a dollar range here for wheat. So a push lower down into retesting those big support areas, not out of the question, and I think unfortunately could be part of the reality. So let's take a look at what some option premium might look like right now. If there's anything to do in these markets, I'm thinking that right now corn. Volatility has been very, very down. I was doing with, I dropped my pen here. Over the last several months, we were doing a lot more of those types of maybe price protective strategies where we were buying puts, selling calls above. We were looking as far out as December corn. Back then, to walk you through some of the ideas, this was a protective strategy in new crop corn way back. I mean, we were selling 480 calls back then. We were bringing in 6, 7, 8 cents. I mean, that was months ago. Obviously that's decayed away and things have changed. We've fallen considerably since then, but even still, if you are looking to have protection on in this market, a 310 put costs you 10 cents here. It is bid 10 and 7/8 cents, offered at 11 and 1/8 cent here in the July options in corn. That 310 put gives you protection all the way out to the end of November of this year on your corn. We all know how puts work. It puts that floor in at 310 with December corn trading at 334 right now. So you have 24 cents of downside potential that you could get hit on, but you've got a floor in there. Now you could bring that up to 320 and spend 15 cents, right? That's what it's offered right now. Going to market would buy one 320 at 15 cents. I'm not saying do this. These are just we're just merely going over what the option market is demanding you pay for that type of protection. It's like looking at what is real-time insurance quotes and what does that type of cost you. It's good to think about. So 14 cents in the money is going to cost you about that 15 cents, and that's fine. I think that's a reasonable type of cost, right, to an option. But we can do better because, if we're thinking that this market might be more caps now, by $4 to the upside, well, we could at least cut down or even cut that cost almost in half by turning around and selling calls, at $3.84 and $3.90 or $4, $3.90 and $3.80 strikes. I mean, you can bring in 7 cents. By selling with 380s, bring in 6 cents for selling 390s, and bring in 4 3/4 cents for selling $4, where the market is right now. So by selling calls against a long put position, you end up helping pay for that protection. Now, we do limit upside potential because these calls represent a ceiling for how good price can improve in the December contract. And of course, we're looking at 334.5 right now. So you're still talking about at least 50 to 70 cents of improvement for those option strikes. So if we were to rally up to $4, hey, you spent some money, you had a floor in, you could sleep at night. It cost you 10 to 14 cents. You brought in, let's say, 5 cents, so that cut the cost for either in half or down to 10 cents. So you only spent 5 to 10 cents now. And hey, you just saw the market go all the way up to $4. Your corn, if we locked in the basis, and did a good job for you, you would be looking at, potentially 64 or 66 cents a gain between, where the option is today, or excuse me, where the market is today and where that option strike price is. And if you did a good job of locking in your basis, you've effectively just improved on price. All the way and you did your cash sales at $4. So be it. That's a 66-cent improvement on the board here. I think that would be a worthwhile consideration. That all of a sudden that's 50 cents of improvement when corn was trading, darn near $3 in our July contract, or 322.5. So. But with all that being said, and then again, that affords you downside protection all the way into new crop. So how do you deal with all that time premium in new crop? Well, there you go. There's one idea of how to help pay for it. Of course, this doesn't mean that these strikes work for you, or these prices work for you, or even this time frame works for you. Because if December might be a great period, but what if you want to deliver corn further out? What if we want to go out, to March or May of next year? March, now you're talking $4 calls are bringing in 8 cents. A 320 put's going to cost you 12, and a 30 put's going to cost you 16. So there is something to be worth saying that, hey, if depending on the type of strategy or the type of protection you want, require, and are looking for, there is something to do and look at in the markets at almost all points in time. And then, working around your financial situation, you can come up with a plan that makes sense as to how much risk appetite you have in the futures. Because even though we're looking at maintaining a hedge here and putting on protective strategies, there's still risk associated with that. And knowing that there are financial risks with futures is important. But if you're one that is looking and knows that you have a delivery point and a delivery, or at least a delivery period and window that you are going to be selling this grain, that is where, give me a shout out, reach out to me. We could talk about setting up a strategy that handles the delivery for that grain in that window. You can pick the place and the delivery point. We help you with the cash sale. We lock in the basis, and over between now and that delivery window, we can take over and help you with the pricing strategy for how to improve on price. And a lot of it will rely on doing things like selling options to bring in that premium, but that requires margin and requires capital put up in a futures account. And that, of course, is risk to you, the trader. So if you're looking to potentially utilize and tap into the value of having that physical grain and want to take that grain and be able to afford a hedge using that grain as collateral, we can definitely look into one of our managed pricing programs for you, and would love the opportunity to show you how Zaner Ag can help you improve on price over the next couple months. With that being said, soybeans, we were taking a look earlier at potentially, a run down to the 8.20 area. What if we go to $8 again in soybeans? How do we get some protection? How can we afford to look at a move to the downside in this market? Well, 8.20, the prior low for soybeans in July contract. Again, there's only 38 days left till expiration on these, but if the move's going to happen, it's probably going to happen now or over the next 38 days. And it could be totally wrong there. We could stay in an 860 to 820 range. That's, of course, probably more likely than anything. But 820 puts right now going for 7 cents, 6 3/4, 7/8 bid, 7 1/8 offered. 7 cents to own the low a put that would go in the money if we go through the low on the July contract in soybeans. You can turn around. We can look at selling calls there, but there's not much time value and much premium to do so in something like that. So in a strategy like this, it almost makes more sense to say, okay, well, maybe just owning those at 7 cents is worth the risk. But is it worth 38 days of carry for it? I don't know. There's a little more speculative nature there. But again, if you're afraid of that drop happening over the very near period, why pay anything more for anything longer term when we're really only concerned with that here and now? When we look at the chart of soybeans, it's very much, a concern that we are going to break these lows, I think, now and head lower. If we don't do that, we're just in a range that we've been in, and we don't really need that afforded protection. Granted, and that's why I don't think sticking your neck out in terms of how much insurance do we need right now is necessary. Now, this also has a lot of hope behind it because we've seen an increase and an improvement in the export market. I do believe that we are going to continue to see that improve. And we're already starting to see talks, I know, here of, the bailout. I know we got news today. Trump announces the $19 billion to farmers, ranchers to maintain the health of the food supply chain amid the coronavirus. That's, the equivalent of another MPP payment, I believe, or another, it's not going to help supply and demand, but it is certainly going to help a lot of farmers and help you guys, bridge the gap. That's great and all, but we have started to see China come in, and talks of China actually maybe picking up on their phase one deals. And more importantly, we've started to see the actual flash sales, nothing today, but we have seen them this week, and the exports, which we're expecting, I think, a pretty good export number this next week. And we'll see where we'll talk more actually on Thursday, when we'll have Ted Seifried of Zaner Ag Hedge on here to discuss in a little more detail and go over some of what Zaner Ag is looking for as our captain and commander-in-chief over here is looking for his outlooks going into this marketing year. So with that being said, soybeans, pretty cheap puts here in the near term. If you're going further out, all the way out to November here, there's still a lot of, I think, good premium to be had here around these at the money puts. I mean, it is 42 cents here for an 860, the at the money or slightly in the money put. That's a lot of premium between now and November. So this market thinks that volatility in the soybeans is there, and to sell you an at the money put, they're charging you 42 cents there. To sell you that same call, they're charging you 33, and that is that 10-cent difference between them. But because we are trading 851, so we're a little close to the 860 than 830, or I'm sorry, the 850, which is slightly out of the money, versus the anyway. Nevertheless, we're kind of skewed here to the put side, so this market still thinks we have maybe some downside to go. But we shall see how we settle up today. That's really all I've got for you guys. We'll go over a few more option strategies, but it helps more to frame these, with a particular situation in mind. So if anyone has a situation they want to take a look at, feel free to reach out to me, give me a call. Always here to chat, 312-277-0110. That's 312-277-0110. Shoot me a tweet on Twitter, Daniel Hussey Jr., or hit me up on Facebook at Daniel SOTD, or shoot me an email at dhussey@zaner.com. With that being said, everyone, have a great day. We'll be back with you as price action develops. Take care, everyone.